Ladies and gentlemen, NIO earnings call revealed a demand surge exceeding production, leading to potential output boosts. Despite this, earnings fell short, impacting market reactions. Let's dive into the latest NIO earnings call, where some fascinating insights and updates were shared. NIO is currently experiencing a unique situation. There's a demand surge that surpasses their production capabilities, as highlighted by the CEO. May saw orders outstrip their production, which is at its peak capacity for the month. This demand overflow is prompting NIO to explore ways to boost their output to match the high order volumes, which is a positive challenge to have. However, despite this promising demand scenario, the market reacted negatively to NIO earnings report. The revenues and key metrics fell short of estimates. Let's unpack the reasons behind this. Starting with the numbers, NIO vehicle sales hit $1.16 billion in Q1 2024, with a vehicle margin of 9.2%. This compares to 5.1% in Q1 2023 and 11.9% in Q4 2023. The dip in vehicle margins is attributed mainly to a shift towards 2024 variants and significant inventory clearance discounts for 2023 models earlier in the year, particularly in February and March. These discounts impacted overall vehicle margins. Total revenues stood at $1.372 billion, reflecting a 7.2% drop from Q1 2023 and a substantial 42.1% decline from Q4 2023. The net loss came to $718.1 million, driven largely by higher research and development R&D and selling, general, and administrative SG&A expenses. R&D expenses reached $396.7 million, and SG&A costs were $415.1 million, up by 22.5% from Q1 2023. This increase was mainly due to higher personnel costs related to sales functions, expansion of the company's sales and service networks, and increased marketing activities. On the financial front, NIO had $6.3 billion in cash reserves as of March 31, 2024. For Q2, they project deliveries of 54,000 to 56,000 units, translating to approximately 18,000 to 20,000 units in June, despite having 30,000 pending orders. This production cap highlights their current production constraints. They forecast Q2 revenues to be between $2.297 billion and $2.373 billion, indicating a potential increase of 89.1% to 95.3% compared to Q2 2023. As of the latest update, NIO operates 154 NIO houses, 288 NIO spaces, 344 NIO service centers, and 64 NIO delivery centers. The limited number of delivery centers seems to be a bottleneck, unable to handle the influx of vehicles. They have also established two 472 power swap stations, with a cumulative 45 million swaps performed, and 22,000 chargers, indicating extensive infrastructure expansion. During the call, there was a notable focus on aggressive promotions versus vehicle margin expectations. The increased promotions during the transition to new models reduced the average selling price, thereby impacting gross margins. This led to lower than expected revenue, compounded by heavy discounts on inventory cars. Despite these challenges, NIO anticipates a recovery in vehicle margins to double digits and plans to renegotiate with suppliers to optimize product mixes and sales strategies. NIO Power, their energy division, is another highlight. They retain 90% ownership after selling 10% for $200 million, emphasizing its expansion phase and future profitability, particularly with ventures like grid stabilization. A single power swap station in Denmark reportedly generates €200,000 annually from grid stabilization alone, sparking investor interest and signaling future profitability with just 60 daily orders per station. Regarding the ONVO expansion, NIO plans to launch 100 ONVO stores, each costing between 1 to 2 million RMB, without the need for elaborate NIO house-style setups. The Onvo L70, a mid-sized SUV, is set to be their flagship product, promising robust sales performance. The CEO also addressed the European Union anti-subsidy probe, calling it counterproductive to green energy initiatives, but assured minimal short-term impact while planning adjustments for long-term compliance. Expansion into the UAE has been delayed, originally planned for June last year, but now pushed further out. Despite these delays, the CEO reassured that the changes in cost structures and promotions have not significantly impacted profit margins. They've managed to reduce battery costs through extended life expectancy and more favorable deals with their battery asset management partners. NIO future product strategy is clear. Focus on premium family and business vehicles priced above 300,000 RMB, mainstream family vehicles under the Onvo brand around 200,000 RMB, and entry-level boutique cars under the Firefly brand around 100,000 RMB. All models will feature battery swap capabilities, enhancing margins through shared technologies and software. The Onvo brand, with its promising pre-sale prices, is expected to achieve healthy margins and break even with 20,000 to 30,000 deliveries per month. Meanwhile, NIO needs around 30,000 deliveries with 20% margins to break even. The CEO expressed confidence in the demand stability and the near-term challenges related to production and delivery capacity. While the current financials might not look great, the outlook is optimistic. The production and delivery capacity constraints are significant, but with ongoing efforts to increase capacity and a strong demand pipeline, the future looks promising for NIO. And let's keep an eye on how these developments unfold. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.